So one of our major focuses for our Modern Nations United States topic is the New Deal, and the New Deal was a government response to a worldwide economic catastrophe, which was the Great Depression. So before we look at the New Deal, we need to look at the Great Depression and some of its causes and the effects it had on the American people. So at the turn of the 20th century, the United States embodied the hopes and aspirations of millions. It was seen as the land of plenty and the land of promise to millions of European migrants coming across. And the American dream culture, was really attractive to people around the world. But like the Gilded Age that we talked about, the appearance of the excess and wealth, underneath the surface there were some really dangerous trends that were taking America very close to the brink of economic collapse. So the Great Depression itself was a severe worldwide economic depression or decline that took place mostly during the 1930s, originating in the United States but spreading very quickly around the world. And so we've talked about this term, a laissez-faire economy, which is where the government has minimal intervention in economics, and that's just part of the capitalist style. And so naturally, economics go through boom and bust periods, or sort of highs and lows, peaks and troughs. So during a boom or a peak period, there's high demand for goods, which leads to the higher production of these goods. And to do that, you need more employment of people to make the goods, and then they have more money to buy more goods. So those are symptoms of a peak period or a boom period. And then naturally, there's usually a decline that follows. Too many goods are produced, which means that people have to be laid off and lose their jobs, which means then there's less money in their pockets to be able to buy consumer goods. And so this sort of diagram sort of sums up what's a relatively normal natural business cycle, where it comes in waves and there's peaks followed by troughs, and that was a fairly normal part of economics. And so we are looking at the Great Depression, which is obviously a very severe trough, one that was very, very difficult to recover from. And so looking at some causes of the Great Depression, there are a few key causes that we're going to look at one by one. The first one is consumer debt. So after World War I, there was an increased demand for goods, but unfortunately most people in America couldn't actually afford to buy them. So what was the solution? They had to buy on credit, which means they got the goods now and paid for them later, much like we'd use a credit card today. So by the end of the 1920s, 60% of the cars and 80% of the radios were bought on this installment credit, and credit debt was around $3 billion. The uneven distribution of wealth in the country, for example, having a small group of people with a lot of money and most people not having much money, that didn't stop those lower classes from wanting those goods, and they were able to get them through this installment credit. But as the economy began to decline and people lost their jobs, they couldn't pay back this money and couldn't pay off their debts, which was causing a lot of issues. So this pie chart here shows that income distribution in America. So you've got 1% earning over $10,000, and most people, 2/3 of people, earning under $2,000. So it shows you that real wealth gap in America, but it didn't stop those middle and lower classes wanting those goods, and they could get them by buying on credit. Another issue which caused the Great Depression is the overproduction of goods. So when there's a high demand for goods, obviously production goes into overdrive, and more of these goods are produced very, very quickly. And during World War I in the 1910s, farmers and businesses produced an excess of goods. They had to, for the war effort, keep producing food and materials. But after the war had finished, the demand for these goods fell. I guess mainly because people couldn't afford to buy these luxury items, and the war machine wasn't ticking over anymore. And so there was this overproduction of goods, which meant that people weren't buying, so there was too many of these goods laying around. Eventually, people had to lose their jobs because there just wasn't enough production happening, and this affected, especially in the farming and food industries, affected around 25% of the workers in the United States. And so this cartoon, shows the American, economic machine going into overdrive, producing, but then who's going to buy them? There has to be someone at the other end to buy them, and that wasn't happening, which leads to this problem of overproduction. And this shows you for wheat prices, for example. In 1925, wheat prices are just under $1.50. and 7 years later they are down to about 40 cents. So I guess when you got too much of something, the price goes down, and that affected the livelihood of a lot of Americans, particularly farmers. Another issue that caused the Great Depression was, I guess, the interrelated nature of world politics, how lots of the world economies were very closely linked. And it basically meant when world trade began to decline, it affected everybody because they had such an interconnected nature. So when world trade declined in the 1920s, European countries had massive war debts to pay, especially to the United States, who lent out a lot of money. And simply, European consumers weren't able to buy American goods, and nobody had that buying power. And therefore, America were making all of these consumer goods and nobody could actually buy them. And so again, it links back to that overproduction. America was making lots of things that couldn't be sold. And because of this close relationship between lots of world economies, the depression and the symptoms of the depression spread very, very quickly. So here's a diagram that shows the financial relationship after World War I between several nations. So you've got the United States lending billions of dollars to Germany to help them rebuild after World War I, who then had to pay their reparations. You might remember back to Year 10 history when you're looking at the huge reparations that Germany had to pay under the Treaty of Versailles to the Allied victors. So the US lent the money to Germany to repay the money to the Allies, and then that money made its way back from the Allies back to the United States because they owed the United States as well. So this was called the Dawes Plan. It's a financial, I guess, a repayment plan after World War I, but it shows the strong link on how these economies relied on each other, and when one was experiencing these declining economic symptoms, it affected all of them. And this year, the stock market crash is a major symbol for the Great Depression, and lots of people see it as the cause of the Great Depression, but it was merely one of many. So the stock market crash happened in October 1929 on a day which was known as Black Tuesday, where the stock prices plummeted off the scale and lots of people lost their life savings literally overnight. And so just a quick, background into, playing the stock markets, which was called margin investing. So lots of people actually basically bought these shares, similar to the installment plans. They bought these shares on a margin requirement, which means they only had to pay 10% of the share, and then they could own it. And they, in the future would be able to pay back the rest of what they owed when the share price went up. So if a share price was, $10, they would only have to pay $1, and then they still started to accumulate that debt, which they hoped they would be able to pay back. So this was called speculation, speculating and predicting the stock market in order to make money. So this was a typical get-rich-quick type attitude that lots of people had by playing the stock market. And normal people, not just rich people, leapt at the chance to invest in business. And this is still how the stock market works today. Where investors buy a stock that they think is going to, go up in price, and then when they think that the price is going to go down, they try and sell it at the highest price to make money, and that's how playing the stock market works. So because lots of people bought their stocks on a margin, like a loan, lots of people actually still owed a lot of money. Companies actually lied about their profits, which means people bought into companies which weren't going as successfully as they thought. And therefore they were getting themselves into a lot riskier situation than they expected. Because of this laissez-faire economy, it meant that there was no real control on the stock market, and because the government had minimal intervention, it was just free to run its own course, and there were some very dangerous trends happening in the stock market. And so the Great Crash happened in 1929, and this is a good cartoon that shows exactly how far down it went. $30 billion basically evaporated in the space of a couple of days, and that meant that people who had all of their wealth and money tied up in these, in speculating these stock markets, vanished overnight. So the crash of 1929 is also brings up images of suicides and people that you know, coming to grips with the fact that that bubble had burst and they had literally lost all of their savings straight away. And here's some more graphics of how quickly that economic situation declined so quickly. And so basically, a flow-on effect from this is because the stock market crashed, people began to panic and they began to think, well, if this stock market is on the way down and prices are going down so quickly, we need to get our money out as quickly as possible so we don't lose any more. And basically, lots of banks started to collapse because they couldn't deal with the amount of money and how quickly people wanted to withdraw their savings, and so this very quickly lent to these small banks, which were independent companies basically, collapsing and not being able to give people their money back, which caused huge issues. And so this is why these banks failed. They weren't insured, and when people needed their money back out, they had to basically close their doors. And so back then, banks weren't safe places. They weren't. You couldn't, I guess, you couldn't count on your money being there when you wanted to withdraw it. And this is what happened to a lot of people when they panicked and wanted to withdraw their money after the stock market crash. And as you can see here, after 1929, the amount of bank failures, skyrocketed up to 4,000 in 1933. So that is, I guess, a quick crash course. I don't know if it was a terribly good one into some of the economic issues behind the Great Depression. And in the next video, we're going to look at life for Americans during the Great Depression.